Today, we're going to be tackling a question that I think is going to resonate with all of us as investing enthusiasts.
Yeah.
Is the long run lying to you?
Ooh, that's a good one.
It is. We're diving into some excerpts from a really insightful article by Cliff Asness
Yeah.
with that very same title.
Love Cliff.
He takes a deep look at how these shifts in valuation can really mess with our perception of investment returns,
Yeah.
even over what we traditionally consider the long term.
Right. What's so fascinating about this topic is that, we often lean on historical returns
Right.
as like our compass for future expectations.
Yeah.
But Asness makes this really compelling case that just looking at simple average returns
Right.
can be really misleading, especially when those valuations have changed so much over time.
Yeah, that makes a ton of sense, especially now when we see some assets like U.S. stocks hitting those record high valuations.
Right.
It makes you wonder if those historical returns are truly sustainable.
Exactly, and that's the crux of it. Let's take the S&P 500, for instance.
Yeah.
From 1950 to 2020, it delivered an average annual return of around 6.5%.
Okay.
Sounds pretty impressive, right?
Definitely. That's the kind of number that gets people excited about long-term investing.
Exactly. But here's the catch.
Right.
That period includes this massive expansion of the EPE ratio, which is basically measuring how expensive the stock market is relative to its earnings.
Right.
So those stellar returns might be partly due to that expanding valuation,
Right.
not just pure earnings growth.
So are you saying that those 6.5% returns might be overstating
Potentially.
the actual potential of the S&P 500 going forward?
Yeah, that's a key takeaway. When
Okay.
you adjust for those valuation changes, Asness estimates that the return drops closer to 5.2%.
Okay.
That's a pretty big difference when
Yeah.
you think about it over the long term.
It is.
It's like that old saying about a rising tide lifting all boats.
Right.
Just because the boats are higher doesn't mean they magically became better boats, right?
It's a great analogy.
Yeah.
So if valuations are already high,
Yeah.
we shouldn't necessarily expect the same level of returns going forward.
Yeah.
It makes you think twice about chasing past performance.
Yeah.
What about other asset classes, though?
Okay.
Do these valuation shifts affect bonds
Yeah.
in the same way?
So bonds tend to have less dramatic valuation swings over long periods.
Okay.
So historically, their simple average returns have been closer to their valuation adjusted returns.
Okay.
Think of them as a bit more stable, less influenced by those big swings in market sentiment.
So in a way, bonds have been a bit more predictable,
Yeah.
at least from a valuation perspective.
However, there are exceptions.
Cool.
If we look at bonds since the start of that big bond bull market back in 1984,
Okay.
we see a different picture. Simple average returns were pumped up because yields were falling.
Okay.
So investors who hopped in then shouldn't expect those same juicy returns to continue indefinitely.
Interesting point. It seems like understanding the historical context of valuation is really important, no matter what asset class we're talking about.
Absolutely. Asness also highlights another really compelling example.
Yeah.
U.S. versus international stocks.
Mm-hmm.
We often hear about the dominance of the U.S. stock market,
Yeah, right.
especially in recent decades.
Right.
But a big chunk of that outperformance might be attributed to a shift in relative valuations.
Sorry.
The U.S. market has simply become more expensive compared to international markets,
Got it.
particularly after the Japanese bubble burst in the late 1980s.
So it's not necessarily that U.S. companies suddenly became so much better than their international counterparts.
Yeah.
It's partly a valuation story.
Exactly, and that raises a really important question.
Really?
For investors who might be dumping international stocks based solely on recent performance,
Uh-huh.
what if that valuation gap between the U.S. and international markets doesn't continue to widen? Could they be making a big mistake?
That's a great point. It seems like chasing performance without considering valuation can be a real trap,
Yeah.
especially when comparing different regions.
Now let's shift gears to a topic I know many investing enthusiasts are curious about,
Okay.
the value factor.
Yeah.
It's taken quite a beating in recent years,
It have.
and a lot of people are wondering if it's truly dead.
Right.
Asness digs into this as well, and his analysis is quite revealing.
This is something I've been following closely, so I'm really curious to hear what he has to say.
He found that value spreads,
Okay.
basically the difference in valuation between cheap and expensive stocks,
Right.
have actually widened significantly over the past few decades.
Okay.
This has had a major impact on value returns, making them look worse than they might actually be.
So you're saying even though value investing has underperformed, it might not be as dire as the raw numbers suggest.
Right. Once you factor in the spread, widening the estimated average return for value investing since 1990 is much closer to its historical average than many people realize.
That's a really interesting insight. It kind of reframes the whole narrative around value investing's struggles.
And here's where it gets even more interesting. As Asness specifically looked at the period from 2018 to 2020, which was a brutal stretch for value stocks. But his analysis shows that while the simple returns for value were deeply negative, the valuation-adjusted returns were much less bad.
Wait, so even during a value crash, the adjusted numbers paint a less scary picture?
Exactly. It really highlights how much those short-term swings in value investing are driven by shifts in valuation rather than just fundamental changes in the companies themselves.
Now, I know a lot of investors have been debating whether these findings hold up if you use different value metrics. We often talk about book to price, but are there other ways to measure value?
Asness actually explored another value factor based on sales to enterprise value, or SEV. And guess what? The results are remarkably consistent. Whether we're using book to price or sales to enterprise value, adjusting for those valuation changes gives us a more stable and arguably more accurate estimate of the value factor's expected return.
Wow. So whether we're looking at book to price or sales to enterprise value, it seems like those valuation shifts play a massive role in shaping the perceived performance of value investing.
That's a critical takeaway for all of us as investors. Don't just get caught up in those simple historical returns. We need to dig deeper, understand the impact of valuation shifts, and that will give us a much clearer picture of the true potential of our investments.
This is all such great food for thought. It's really making me rethink how I approach analyzing investments.
You know what's really interesting is that when we break down returns this way, we start to see two distinct but related effects at play.
Oh, that's intriguing. What are these two effects?
Well, first, there's the possibility that the expected return for an asset or a strategy is actually different from what those simple average returns might suggest. This happens when valuations have shifted significantly over the period we're analyzing.
So if valuations have gone way up, those simple average returns might be giving us a false sense of optimism about future returns.
And on the flip side, if valuations have fallen, those simple averages might be understating the potential.
That makes sense. It's all about context, isn't it?
Yep.
What's the second effect?
The second effect has to do with precision. By taking valuation changes into account, we actually gain more confidence in our estimate of the true expected return.
So even if the expected return itself doesn't change drastically, we have a better grasp of its accuracy.
Exactly. We move from a fuzzy picture to a much clearer one.
Got it.
And that's incredibly valuable for us as investors, wouldn't you say?
I would say.
It helps us distinguish between real sustainable returns and those that might just be a fluke or driven by temporary factors.
Absolutely. It's like having a more reliable compass to guide our investment decisions. It gives us more conviction in our choices.
Now, it's worth noting that this technique works best for strategies that have a low turnover rate.
Why is that?
Think about it this way. If a strategy is constantly changing its holdings, the impact of starting and ending valuations becomes less significant. There are simply too many moving parts to accurately assess the valuation impact.
So it's harder to isolate the effect of valuation changes when the portfolio itself is in constant flux.
Yes.
Kind of like trying to hit a moving target, right?
Exactly. That's why this approach is particularly relevant for factors like value investing, which tend to have a lower turnover compared to more dynamic strategies like momentum.
Right. Value investors typically hold stocks for longer periods, which makes this valuation analysis more meaningful.
Now, going back to the value factor, we were talking about how its performance has been distorted by those widening spreads. How does this valuation-adjusted perspective change our understanding of value's performance, especially in those out-of-sample periods since the 1990s?
Yeah, that's a key question. Has value really been as bad as it seems over the past few decades?
Well, when you take that spread widening into account, the estimated average return for value investing since 1990 is still lower than it was pre-1990.
Okay.
But it's not nearly as disastrous as it looks when you just focus on simple returns.
So instead of a complete collapse, it's more like a muted performance.
Yeah.
Due to those pesky valuation shifts.
That's a great way to put it. And what's really important is that if we believe those spreads won't continue widening forever, then this suggests the true long-term expected return for value is actually much higher than what its recent performance might indicate.
It's almost like we're rescuing the value factor from an unfair reputation, isn't it?
In a way, yes. It's a powerful reminder that simply looking at historical returns without considering valuation can lead us to some very wrong conclusions.
It's like we need to peel back those layers and dig deeper to get the full story.
Exactly. And you know what's particularly impressive about Asness's analysis? Is that he doesn't just stop at book to price. He actually tests these ideas using a completely different value factor. One based on sales to enterprise value.
So he's looking at it from multiple angles to see if the findings hold up.
And what's striking is that the results are remarkably consistent. Whether we're using book to price or sales to enterprise value, adjusting for those valuation changes gives us a more stable and arguably more accurate estimate of the value factor's expected return.
It's like those findings gain more weight with each new piece of evidence.
Now, of course, some people might argue that these valuation changes are justified, that they actually reflect fundamental shifts in the market rather than some kind of irrational bubble.
That's a fair point. I mean, couldn't you say that maybe valuations have risen because companies have become more innovative or efficient?
Of course, that's a valid consideration. But if those valuations are truly justified, it simply means we shouldn't expect extra returns going forward based on the current spread. It doesn't change our estimate of the long-term expected return once those spreads stabilize.
So even if those higher valuations are correct, it doesn't mean we should write off value investing entirely.
Precisely. As long as we believe the fundamental drivers of the value premium persist, and we don't expect these spreads to widen indefinitely, then value investing can still be a very powerful strategy over the long term.
This whole conversation about valuation and expected returns is fascinating.
Yeah.
It's really making me rethink my approach to investing. But I'm sure our listeners are wondering, what does all this mean for them? It's all well and good to talk about theory, but how do we translate this into action?
So we've been talking a lot about theory and big picture stuff, but I think it's important to bring it back down to earth and think about what this means for individual investors.
Exactly. Like, how do we actually use this knowledge about valuation to make better decisions with our own money?
The first step is to be really honest with ourselves about our expectations. If we're blindly chasing those historical returns without understanding the role of valuation, we're setting ourselves up for disappointment.
It's like expecting the same gains from a stock that's already doubled in price.
Exactly. We need to adjust our expectations based on where valuations are today.
So if valuations are high, we should probably temper our enthusiasm a bit.
Exactly. And on the flip side, if valuations are low, that might be a signal that there's more potential for upside.
Makes sense. So it's not just about finding good companies or strategies. It's about buying them at the right price.
That's the key. It's like anything else in life, You want to get a good deal. You don't want to overpay.
Makes sense. What are some practical things investors can do to incorporate this valuation awareness into their process?
One thing is to broaden our horizons beyond just the U.S. market. We've talked about how the U.S. market has become relatively expensive. Compared to other parts of the world. So looking at international markets might offer some opportunities.
Especially if those valuations are more attractive.
Exactly. And it's not just about geography. We can also think about different asset classes. We tend to get fixated on stocks. But there's a whole world of other investments out there. Bonds, real estate commodities. And each of these has its own valuation dynamics.
So we need to be just as valuation conscious when we're looking at those other asset classes.
Another important point is to not get too caught up in the short-term noise. We've seen how those short-term fluctuations in the market can be heavily influenced by those valuation shifts.
Like those brutal years for value stocks.
Exactly. So don't panic if your investments go through a rough patch.
Easier said than done.
I know, but if you've done your homework and you believe in the underlying fundamentals, staying the course can often be the best strategy.
So it's all about having that long-term perspective.
Exactly. And remember, this whole idea of valuation-adjusted returns is just one tool in our investing toolkit.
Right.
It's not a magic formula.
Of course.
But it can help us make more informed decisions.
This has been a really eye-opening conversation. I feel like I have a much better understanding of how valuation impacts returns.
I'm glad to hear that.
And more importantly, how I can use this knowledge to improve my own investing approach.
That's what it's all about.
Okay, so we've been talking about how to incorporate this valuation stuff into our process.
Yeah.
Are there any other concrete tips or things that you think investors should keep in mind?
One thing that I always emphasize is the importance of diversification. Don't put all your eggs in one basket.
Right. That's classic advice.
It is, but it's so important, especially when you're dealing with something as complex as valuation. By spreading your investments across different asset classes, different geographies, different sectors even, you're reducing your risk and increasing your chances of success over the long term.
And diversification can also help smooth out those returns.
Exactly. It's like a shock absorber for your portfolio.
Yeah, it helps you ride out those inevitable bumps in the market.
Another tip is to be patient.
Okay.
Investing is a marathon, not a sprint.
Right. The long game.
Exactly. Don't get discouraged if you don't see immediate results.
Yeah. It's easy to get caught up in that short-term noise.
It is. But remember that true investing success is about building wealth gradually.
Right.
Over time.
No, so stay focused on your goals.
Yeah.
And don't let those day-to-day fluctuations shake you off course.
And finally, I would say don't be afraid to seek professional help.
Okay.
If you're feeling overwhelmed by all this, or you're just not sure where to start.
Right.
There are plenty of qualified financial advisors out there.
Okay. Who can help you create a personalized investment plan.
It's okay to ask for help.
Absolutely. Investing is a journey.
Yeah.
And it's always good to have a guide.
Well, this has been such an insightful conversation.
I'm glad you enjoyed it.
I feel like I've learned so much about how to think about valuation and long-term returns.
Yeah, that was the goal.
So thank you so much for joining me today.
You're welcome.
And for sharing your expertise with our listeners.
My pleasure.
And to everyone listening.
Yeah.
Thank you for tuning in.
We'll be back soon with another episode exploring a whole new topic in the world of investing. Until then, happy investing.